Yes. So the following information was extracted from the financial statements of Excel Limited, 𝗔𝗶𝒄 Limited, and Z Limited for the year ended 30th of June 2024. So you are given the statement of financial position as of 30th of June 2024 for the three companies. So you have in this case the non-current assets, that is property, plant, and equipment. We have intangible assets, which include patents. We have investments, that is only in Excel, the investment they have done. We have the current assets. We have trade receivables. We have financial assets at fair value. We have bank and cash balance. We have equity, where we have ordinary share capital, share premium, retained earnings, totaling to the shareholders' funds. We have the non-current liabilities, which is made up of 10% debentures, deferred tax. We have trade payables, we have current tax, and you have proposed dividends. Then you have the total equity and liabilities. You are given a number of additional information there. Excel acquired its investments as follows. So in 𝗔𝗶𝒄 Limited, Z Limited, number of shares, cost of investment, what they incurred to invest, the retained earnings at that particular point in time, and their dates of acquisitions. So Excel Limited also invested in 10% debentures of 𝗔𝗶𝒄 Limited. So part of the investments, it was not only in this case in shares, but it was also what in the debentures. The fair value of the non-controlling interest in 𝗔𝗶𝒄 Limited amounted to what? 240 million. And remember, we said whenever you see the examiner having to tell you that the fair value of the non-controlling interest, what does that basically indicate to you? When the examiner tells you the fair value of the non-controlling interest, what does that indicate to you? You use the full method to calculate what? Goodwill. You use the full method to calculate what? Goodwill. You don't have to think twice. So that is the most automatic thing the examiner is trying to allude to there. The group use the full goodwill method. So I don't know why they have told us, yet we already know. So however, it does not amortize goodwill. Instead, goodwill is assessed for impairment annually. Impairment test for the year ended 30th of June 2024 revealed that none of the goodwill is impaired. So when you calculate the goodwill, you won't actually end up having to do impairment on it. So there was no need for them having to give us that statement because it won't help us anywhere in any computations. It's just having to, in this case, do what? Give us a lot of unnecessary information because you already know in this case, if they are giving us the fair value of the NCI, then you're using the full goodwill method. If you're not having to impair, what is the essence of having to tell us? So there's no need. So in this case, immediately prior to the date of the acquisition, 𝗔𝗶𝒄 Limited revalued its non-current assets in readiness for acquisition, as shown below. So this is 𝗔𝗶𝒄. So at that particular point in time, they were having to acquire it. They did some revaluation of assets. So on the date of acquisition, there was what we call what? Revaluation of the assets. So that is what we call what? It will create a revaluation reserve. It will end up having to create a revaluation what? Reserve. Then we'll also be able to consider that revaluation reserve as what? A pre-acquisition revaluation reserve or revaluation reserve or the reserves at what? At the date of acquisition. They'll be very important when you're having to compute what? Goodwill. Equipment and patents are depreciated or amortized on straight-line basis over the remaining useful life, respectively, by Excel Limited. So because there was a revaluation, there'll be a depreciation undercharge and in this case, an amortization what? Undercharge. We will have to consider. Then during the year ended 30th of June 2024, Excel Limited sold non-current assets to 𝗔𝗶𝒄 Limited for 360 million. Excel Limited marked up the equipment at the rate of 20% per annum on cost. 𝗔𝗶𝒄 Limited included the equipment in its non-current assets and charged depreciation at the rate of what? 20% per annum on cost. So that's what we call what? Intercompany sale of what? Of fixed assets. So we have to, in this case, deal with that when you are doing the consolidation. During the year ended 30th of June 2024, 𝗔𝗶𝒄 Limited sold inventories to Excel Limited for 300 million. 𝗔𝗶𝒄 Limited marked up these goods at 25% on cost. Half of these goods were still held in the Excel Limited by the end of the year. So this is what we call intercompany sale of what? Goods, intercompany sales. You know, we normally eliminate them. Intercompany sales, we eliminate them. Then in any case, you are told part of these goods were still in the closing inventory. We calculate unrealized profits on closing inventory. We calculate unrealized profit on closing inventory. Then the last statement, 𝗥𝗏 Limited owed 𝗬𝒑 Limited 200 million as at the year end with regards on the transaction in note number 5. The books of 𝗥𝗏 Limited, however, showed that it owed 𝗬𝒑 Limited 160 million. 𝗥𝗏 Limited has sent a check to 𝗬𝒑 Limited of how much? To 𝗬𝒑 Limited on 24th of June, which was not received, but it was received on 2nd of July. That's what we call what? Intercompany owings or intercompany balances, which you normally say you have to eliminate. But sometimes there can be an element of what we call what? Cash in transit. So you can see there's a difference of 40 million there. That is cash in transit, which is yet to be received at that other end. So we have to consider cash in transit of what? Of 40. Of 40. So because there was a check which was sent, maybe it hasn't been received at that other end. That's why they are still having to recognize in this case maybe what? 200. So these are cash in transit. So we'll have to consider that. Calculate the value of goodwill arising on acquisition of investments in 𝗬𝒑 Limited and Z Limited. Then part B, prepare the group statement of financial position as of 30th of June 2024. So we can be able to, in this case, look at what we are supposed to do very quickly there. We can be able to look at what we're supposed to be able to do there very quickly. So we can look at note number 1. Let's look at note number 1. Note number 1. But before that, we've also actually been able to say that in this case, you must always, in this case, be able to consider what we call what? The group structure. So the group structure. The group structure. So the group structure here. So we are told 𝗥𝗏 Limited acquired investment as follows in 𝗬𝒑 Limited and of course what? Z Limited. So you have in this case 𝗥𝗏 Limited. So having to acquire investment in 𝗬𝒑 and of course what? Z Limited. So they acquired them like that. So you are told the number of shares acquired. The number of shares acquired in this one was 16 million. The number of shares acquired in this one was 3 million. 3 million. The number of shares acquired in that one it was 3 million. So when you see the examiner having to give you the number of shares, so they just want you in this case to use this number of shares to know the percentage of control or significant influence. Percentage of control or significant influence. So in this case, what will happen? We have to, in this case, identify what were the total number of shares. What were the total number of shares in Y? What were the total number of shares in Z? And of course, where can you be able to get them? You can look at the statement of financial position. So look at the statement of financial position under the part of what? Ordinary share capital. So you're having to be told that in this case, the ordinary share capital in this case for 𝗬𝒑, it is 400 million. So in this case, what? Z, it is actually how much? 200 million. So how many number of shares do we have in this case in Y or 𝗬𝒑? How many number of shares do we have in this case in Y or 𝗬𝒑? How many number of shares do we have in this case in 𝗬𝒑? So it is 20 million. It is 20 million. Yes, 20 million. How do you get this? You simply take the 200 million divided by 20. 400 million divided by 20, you get 20 million. What about in this case in Z? What about in Z? What about in Z? What about in Z? It is 10 million. So it is 10 million. It is 10 million. Therefore, in this case, it means what X has been able to acquire in Y, it is what? If you take 16 over 20 times 100%, what percentage do you get? 16 over 20 times 100. What percentage do you get? You'll be able to get what percent? Is faith, 80%. You'll be able to get 80%. This one is automatic. 3 out of 10, 30%. Therefore, this one is what? Is a subsidiary. This one is what? An associate. This one is a subsidiary, and of course, this one is what? Is an associate. Is an associate. And therefore, for this one, you'll likely be able to consolidate normally by having to add the assets of what? Because in the second part, they are calling upon us to be able to prepare what? The statement of financial position. The statement of financial position. Under the statement of financial position, we'll be able to add the assets of 𝗥𝗏 Limited and those ones of what? Of Y Limited, because it was what? A subsidiary. But this one, we won't add the assets. But in this case, you'll be able to compute a very important figure to be placed in the financial statement of financial position. What do we call it? We'll be able to compute a very important figure to be placed in regard to the Z. We call it what? There's a figure we need to be able to compute to place it in the statement of financial position, other than having to add its assets. We won't add them. But we'll compute a very important figure. We call it what? Investment in associates. So again, what will be happening, we'll be taking the assets of Excel Limited as the holding company. Those ones of 𝗔𝗶𝒊𝒏𝒈 Limited, we add them together. If there are any adjustments, we'll be able to make the adjustments. But the assets of the associates, we'll only be able to account for it as what? Using the equity method, whereby you have to compute what? The investment in associate. That is very important to take note at this particular point in time. Then remember we said, whenever in this case, we're having to look at the group structure, always in this case, consider what were the date of acquisitions. They are very important. Sometimes you might end up having to realize maybe the subsidiary who ended up having to be acquired what? In between the year, in the middle of the year. So it means in that case, for example, if it's the income statement, we'll have to, in this case, do what? Apportion. We'll have to apportion what? The expenses of what? Of the subsidiary. But here, we are basically, in this case, coming up with what? Statement of financial what? Position. So it doesn't matter. But in this case, we already have the date of acquisitions. So this one was acquired on 1st of July 2022. So it means by the time we are preparing the financial statements, this subsidiary has been part of the group for how many years? By the time you're preparing the financial statements, this subsidiary has been part of the group for how many years? This subsidiary has been part of the group for how many years? It has been part of the group for how many years? 2 years. 2 years. Then, of course, this other one, it was acquired on 1st of July 2023. So 1st of July 2023. This one has actually been there for only one year. It has been there for only one year. It has only been there for one year. It has actually only been there for 1 year. It has actually only been there for 1 year. Then, if you look at, in this case, still just not number one, you are told cost of investments that they incurred Excel Limited to acquire 𝗔𝗶𝒊𝒏𝒈 Limited, it was 960 million. Then, of course, in this case, for Z Limited, it was 240 million. It was actually, in this case, what? 240 million. So these were the investments they actually made. So if you are able to consider this one, if you're able to consider this one, it simply basically means in this case, we have in this case 2 important figures there. So you have in this case, the purchase consideration for 𝗔𝗶𝒊𝒏𝒈 it is 960. Purchase consideration for Z Limited is 240 million. These will be very important figures when you're having to do what? Come up with the goodwill. Because we normally start with what? Purchase consideration. They'll be very important figures when you're coming up with what? With the goodwill. But further to this, you are told, Excel Limited also invested half of the 10%, also invested in half of the 10% debentures of 𝗔𝗶𝒊𝒏𝒈 Limited. The fair value of the non-controlling interest in 𝗔𝗶𝒊𝒏𝒈 is actually what? 240. So that will be able to help us to come up with what? With the goodwill. But what is so much important, we need to, in this case, see how we'll be able to account for this cost of investment. So we'll have in this case what? The purchase, we'll be able to debit the purchase consideration. Purchase consideration. So in this case, we'll have 960 plus 240, which basically in this case comes to 1200. It comes to 1200. But now, remember in this case, we have a figure for investment. There's that figure for investment there. There's that figure for investment there in the statement of financial position, which in this case amounts to what? 1400. 1400. What will happen? You know, an investment, when you're now doing the consolidation, is like an intercompany balance. We end up having to eliminate it. And of course, when you're coming up with the statement of financial position, we will say this 1400 you have to less this what? 1200. So it means basically in this case, we'll actually be crediting or be removing it from there. So we'll actually basically remove it from there. So we'll remove it from there. So we'll credit the investments. We'll credit the investments in this case by 960 plus 240. So that ideally will be an amount of what? 1200. So ideally it means when you're coming up with what? The statement of financial position, we have to eliminate these ones because they were paid to a member of the group to acquire what? The shareholding. It's like just having to eliminate an intercompany balance, money that was paid from one member of the group to the other. So we eliminate it. So you basically, in this case, remove it. You likely remove it. You likely end up having to do what? To remove it. You likely end up having to remove it. But now, you also told that 𝗥𝗍 Limited also invested in half of the 10% debentures in 𝗲𝗄 Limited. What is the value of debentures in 𝗲𝗄 Limited? What is the value of debentures in 𝗲𝗄 Limited? What is the value of debentures in 𝗲𝗄 Limited? The value of debentures you can be able to see in 𝗲𝗄 Limited is how much? The value of debentures in 𝗲𝗄 Limited, I can see you are saying 400. Yes, it is 400. Yes, it is 400. So they invested in what? Half. There was an investment in half of the what? The debentures. You have investment in half of the debentures. We have investment in half of the debentures. So they actually invested in half of what? Of the debentures. They invested in half of the debentures. It means in this case, that was an amount of a half times 400 million. So they invested how much? 200 million. 200 million. They actually invested 200 million. What you can be able to discover, it is that, of course, they have a total investment of how much? 1,400. So part of it has actually gone to what? To the purchase consideration, which is totaling to what? 1,200. When you take this plus this, you get 1,400. It means that figure having to appear as 1,400, it is basically comprising of what they paid to acquire the shareholding in the companies and also what they paid to acquire what? The debentures. If you total, you likely basically come up with what? 1,400. So it means in this case, what will happen here, we are basically going to do what? The debiting of the debentures. We'll basically eliminate this figure from the debentures. We'll debit the debentures in this case, 200 million. And of course, in this case, we'll end up having to credit what? Investment, 200 million. So what will happen? In any case, we're having to consider investments in the statement of financial position. We'll end up having to say 1,400 minus 960 minus 240 minus 200. Because these ones are like what? Intercompany balances, which we say in consolidation, you do what? You eliminate them. Because what is happening here, they paid these guys, they paid this 𝗲𝗄, gave them money. It is an intercompany what? Tradings that basically you must actually end up having to do what? Eliminate them. You eliminate them. Money moving from here to here, you eliminate it. So we'll basically eliminate this 1,400, eliminate 960, eliminate 240, and again it will remain to be 0. So it means we won't have investments in our statement of financial position. Still at the same case, in this case, remember we are having to do what? Debit debentures. When you're debiting debentures, it is a liability. So we'll be able to say there, corporate non-current liability to the same debentures, 400 minus 200. We'll remove this. We'll remove that. So we'll remove in both sides. We'll actually basically remove in both sides. We'll actually remove in both sides. So I think there's a problem. Let me see. The board is not clear. The board is not clear. The board is not clear. Confirm if there it is clear. Confirm if there it is clear. Confirm if there it is a bit clear. Confirm if there it is a bit clear. It is better. It is better. So I think we can proceed. So we're having to say in this case, this one will end up having to eliminate from debentures. So we'll do 400 minus 200, when you're basically coming up with what? The statement of financial position. And therefore, in this case, that is what we'll be able to do. That's how basically you can be able to interpret part of the figures there. So put still in note number one, you've actually been given the retained earnings at the date of what? Our acquisition. 300 and 200. Those are what we call what? Pre-acquisition. Pre-acquisition what? Retained earnings. They'll be very helpful when you're having to come up with what? The goodwill. They'll be very helpful when you're coming up with what? With the goodwill. And of course, that is basically, in this case, you'll be able to deal with that. So you can be able to consider what we've just been able to write here as maybe what? Our first working. You can just be able to consider it as our first working there. So as our first working. So the fair value of non-controlling interest, that one will be able to use it when you're now coming up with what? With the goodwill. Then note number 3, immediately prior to the date of its acquisition, 𝑬𝒏𝒕𝒂𝒃 Limited revalued the non-current assets in readiness for acquisition as shown below. So in this case, you have what you call what? We have in this case revaluations. We have in this case revaluations. So we have in this case equipment. So it was from an amount of 500. In this case, an amount of, and of course, in this case, our workings are basically in shillings of millions. So you have to consider that. So 500 in this case, what? 580. So there was a revaluation gain of how much? 80. There was a revaluation gain of 80. Then you have patents. Patents are intangible assets. So that is in this case from 300. In this case, how much? 320. And that in this case, there was a revaluation gain of how much? 20. There was a revaluation gain of what? Of how much? 20. So because these assets were actually in this case revalued, then there arises what we call what? A depreciation undercharge. In this case, what you call what? A depreciation undercharge. So it means it's, in this case, simply, they never considered depreciation on this revaluation. So these ones, they don't depreciate, they're amortized. They are amortized. They didn't consider what? Depreciation on these ones. But of course, in total, there's a revaluation gain of how much? 100. So there's a revaluation gain. Over 100. So this basically will be the revaluation reserve on acquisition. It will be the revaluation reserve on what? On acquisition. So you'll be able to consider it when you're having to come up with what? The goodwill. So remember, we never in this case consider what? Ordinary share capital. We consider share premium, pre-acquisition retained earnings, and reserves, revaluation reserves on the date of what? Acquisition. So this one will use it when you're coming up with what? With the goodwill. We use it when you're coming up with what? With the goodwill. So you are told equipment and patents are depreciated or amortized on a straight line basis over their remaining useful life, respectively, by 𝗥𝗍𝒄 Limited. So they have a remaining useful life of how many years? 10 years. That's what you've actually been told there. So we need to, in this case, calculate the depreciation undercharge on these two. The depreciation undercharge on these two. So we'll calculate depreciation undercharge. You can put it here. Depreciation undercharge. So in this case, we'll take 80 over 10. So in this case, it comes to how much? 8 million. It comes to 8 million. So for this one, what will happen? You'll likely end up having to do what? You will debit. It will increase the expenses in the P&L account. Then we credit the property, plant, and equipment. So they did in this case do what? Do an undercharge. They did do in this case what? An undercharge. And that in this case, we'll likely end up having to do what? Debit. We'll likely debit the retained earnings, which now in this case, it will be like an increase in the expenses. Then we credit what? Property, plant, and equipment, because it will reduce the value of the total property, plant, and that what? Equipment. Remember, this revaluation also will be able to consider it. We'll basically in this case end up having to do what? Debit the property, plant, and equipment, but still the same case you're having to do what? Credit what? Revaluation reserve. So as you are crediting revaluation reserve, we are debiting the respective what? Property, plant, and equipment, because it will increase the value. So it will go up. So we'll debit, but now it will create a reserve of 80. So for this one, we don't depreciate, but we'll consider what? Amortization. We'll consider amortization. The amortization in this case will likely be 20 over 20 over 10, it will likely be 2. It will likely be 2. It will likely be 2. And therefore, in this case, what will happen? Still the same case, we likely debit our retained earnings, but in this case, credit the intangible assets. Credit the intangible assets. There you are not able to see. You're not able to see there. So you're not able to see there. Because let me just make it clear for you. Let me make it clear for you. Let me make it clear for you. So so for the 8 million, we're having to say you likely debit the retained earnings, then you credit the property, plant, and equipment because it reduces the value. You know what depreciation normally does to a property, plant, and it normally reduces. Then in this case, for this one, amortization, it is an amount of 2 million, So the 2 million, we likely end up having to do what? Debit. We likely debit, in this case, what? Of course, the retained earnings. Then, of course, we credit the intangible assets. We credit the intangible assets by that amount. We likely credit the intangible. And of course, if you look at the statement of financial position, you can be able to see there's a figure there for what? For intangible assets. But this one will increase also that value. So we'll add this as we less this. We'll add this as we less this. We'll add this as we end up having to less that. We'll add that as we less that. So that's what will happen with those two items. The next note, during the year ended 30th of June 2024, Excel Limited sold non-current assets to 𝗔𝗶𝒊𝒏𝒈 Limited for 360 million. Excel Limited marked up the equipment at the rate of 20% per annum on costs. 𝗔𝗶𝒊𝒏𝒈 Limited included the equipment in its non-current assets and charged depreciation at the rate of 20% per annum. So you have in this case what we call an intercompany sale of of fixed assets. So we have to calculate unrealized profit on sale of fixed assets. Unrealized profit on sale of fixed assets. Unrealized profit on sale of fixed assets. So intercompany sale of fixed assets. So that is working number 3. So working number 3. Can put it, say maybe working number 3 or what? Working number 3 or maybe what? So intercompany sale of fixed assets. Intercompany sale of fixed assets. So the asset was having to be sold from Excel. In this case, 𝗔𝗶𝒆. So we have in this case Excel. Of course, 𝗔𝗶𝒆, it was for an amount of 360 million. 360 million. So we'll compute the unrealized profits. Unrealized profits on sale of fixed assets. Or we can be able to call it 𝗔𝗶𝒆. We'll calculate 𝗔𝗶𝒆. And of course, in this case, they actually sold it for 360 at a markup of 320. So you have to get the profit on this. So we'll do 360 multiplied by 20 over. It will be 20 over what? It will be 20 over. It will be 20 over. It will be 20 over 120, yes. So you basically convert that markup into a margin. And of course, you remember how we are doing. We are saying 100 plus 20. So 20% simply means 20 over 100. So this is the markup. To convert it to a margin, you take 20, then you take the numerator, you add on the denominator. So 100 plus, this is how you convert a markup to a margin. Because on a sale, on the selling price, it is the margin. To get the portion of the profit on the selling price, we consider the margin. It is basically on the buying price. Basically, in this case, on the buying price or the cost of having to buy, then in this case, we consider markup. So if you are given the markup, always convert to the margin. So don't forget. But if you're given the margin, just use the margin the way it is. So it means in this case, when you do the computation, what you get as in this case as the 𝗔𝗶𝒆, the unrealized profit, what you get as the 𝗔𝗶𝒆, Irene says 600. What? 600 looks to be so big. Irene. So I think that one for Lavin looks looks reasonable. It is 60 million. It is 60 million. 60 million, exactly 60 million. So with this one, you have to know how you are supposed to treat it. You basically, in this case, because it was a profit which was not realized, and it was included in the profits, you actually end up having to remove it from the profit. So you'll debit the retained earnings, you'll debit the retained earnings, then you end up having to remove it from the value of the asset. You remove it from the value of the asset. Then in this case, you credit, in this case, property, plant, and equipment. You credit property, plant, and equipment. So you credit property, plant, and what? And equipment. Then simply because now in this case, you are told that 𝗔𝗶𝒄𝒃 Limited included the equipment in its non-current assets and charged depreciation at the rate of what? 20%. So there's what? A depreciation overcharge on this amount. Because the correct value of this asset ideally is supposed to be 300, but now they have reported it at what? 360. So as you are removing it from here, we are reducing the value of this asset to what? 300. Because in this case, if they debited 360, then we credit 60. So we basically remain with what? 300 as the value of this asset. So what basically was considered as depreciation on this 60, which was an overcharge, which was basically in this case, a value of this asset which was not supposed to be reported. They were supposed to report it at 300. So that's why you're having to eliminate it from the property, plant, and equipment. So it means on this property, plant, and equipment, because they had already considered depreciation, then it means in this case there was what? An overcharge. So we have to in this case compute depreciation overcharge. Depreciation overcharge on this amount. So it will likely be 60. We multiply by in this case what? 20%. 60 multiplied by 20%, you get how much? 60 multiplied by 20%, you get how much? You get 12. You likely get 12. You get 12. So this is what there was what? A depreciation overcharge. So it means in this case, because the assets were overcharged in terms of depreciation, we have to return. We have to return it. So in this case, we'll end up having to debit the property, plant, and equipment. Then, of course, now in this case, we add it back to the profits. We actually add it back to the profits, credit the retained earnings, credit the retained earnings. When you overcharge depreciation, you reduce what? Profits. But now when you correct this overcharge, it means you return the profits back to the normalcy. And of course, if the profit is increasing, always you're having to credit that account. When your profits are increasing in the business, you always do what? Credit. It's an income. So when incomes are increasing, you do what? You credit. When assets are increasing, you do what? You debit. So because the asset will increase, because you will correct the depreciation, you are debiting the specific asset account. So you debit what? Property, plant, and actually what? Equipment. So that's what will happen there. Then note number 5. During the year ended 30th of June 2024, 𝗔𝗶𝒄𝒃 Limited sold inventories to 𝗥𝗏𝒄𝒃 Limited for 300 million. 𝗔𝗶𝒄𝒃 Limited marked up these goods at 25% on what? On cost. So that's in this case what we call what? An intercompany sale. Intercompany sale. That is what we call what? An intercompany sale. So in this case, these goods were sold from who? From 𝗔𝗶𝒄. They were sold from 𝗔𝗶𝒄, in this case, to 𝗥𝗏𝒄𝒃. They were of an amount of how much? 300 million. So of course, automatically what normally happens here, with this 300 million, with the 300 million, you likely end up having to do what? Which account do you debit? You debit sales. And of course, you credit what? Cost of sales. You eliminate them, or ideally you minus. But of course, this one is irrelevant to us because you're not having to come up with what? The income statement. We are not actually having to come up with what? With the income statement. So this one is irrelevant. So what is of so much importance, what you need to be able to compute there regarding now this one is the second part where you are told that part of these goods were still actually basically what? In stock. So you have to in this case calculate the unrealized profit. The unrealized profit in this case on what? On the closing stock. The unrealized profit in this case what? On the closing stock. Why do we multiply by 20%? So 20%. You are told this is the depreciation charge. This is the depreciation charge. It is at the rate of what? 20%. That is the depreciation charge. If you look at that note, just read it to the completion. Just read it to the completion. They had charged depreciation at what? At 20%. So there was an overcharge. Remember the correct value of this asset is supposed to be 300. but they have recognized it at what? 360. That's why we are removing the 60 here to correct the value of the asset to back to 300. We are removing it here. When you credit an asset account, you are removing that amount from that asset account. So it means they considered depreciation on 360, not 300. So they had overcharged depreciation on the extra 60 amount. When you calculate it, you get what? The depreciation overcharge on the extra amount, which is not supposed to be there, we have removed it, is actually what? 12. Is actually 12. Is actually 12. So 𝗂𝗶𝗆 you're having to get. 𝗂𝗶𝗆 you're having to get. It is there. You are told it is there. So that is the depreciation overcharge. Remember, it is depreciation. It is at the rate of 20%. There was an overcharge, which you need to correct it. We need to correct it. We need to end up having to do what to correct it. So we need to, in this case, calculate what? The unrealized profit on what? On the closing stock. So unrealized profits. Unrealized profits on closing stock. Unrealized profit on closing stock. You are told half of these goods were still actually what? In the inventory. So half of these goods were still actually what? In the inventory. So you are told that during the year ended 30th of June, 𝗂𝒏𝒆 Limited sold inventories to Excel of 300. 𝗂𝒏𝒆 Limited marked up these goods by 25% on costs. Half of these goods were still held in the Excel at the year end. So they were still basically in what? In the closing inventory. So we'll be able to calculate these unrealized profits, or what we call UPS, realized profits on the stocks. So it will likely be half multiplied by 300, multiplied by, you're told in this case it is 25%. It will be 25% over what? 25% over what? Over 125. So you have to convert that markup into what? Into a margin. You have to convert that markup into a margin. Sorry, how do we go about intercompany sale of assets? Just the entries. So intercompany sale of the assets. So we've indicated here intercompany sale of fixed asset. You have to calculate what? The unrealized profit on the sale of the fixed assets. How do you do it? You take what was the selling price of the asset, 360. You multiply, they'll tell you there is a markup. They'll tell you there is a markup or a margin. If they give you a markup, you have to, in this case, convert it into what? You have to convert it into a margin. So it will be 20 over 120. You'll get 60. So the entries, the entries, debit retained earnings with the 60, credit property, plant, and equipment. Because this was what? Profit that was not actually realized. So you have to basically remove it from the profits of the business. It was not realized because you are calling it what? Unrealized. Whenever you're having to debit the retained earnings, you are reducing your earnings in the business. You are reducing. It is an income account. When you debit it, basically you are reducing the income, this income. So you debit it. Then remember, these assets is like it was overstated. So you basically eliminate this extra amount that was there from the property, plant, and equipment. The corrective value was supposed to be 300. They were not supposed to, in this case, recognize that profit there. So you eliminate it from the property, plant, and equipment. Then still at the same time, you are told that this company that was actually sold to already, they'd actually considered this asset at 360 in their what? In their assets. So it means this extra 60 million, they had calculated depreciation on it by 20%. So the depreciation on the extra amount of 60, 20% of it is what? 12, which is what? We call it an overcharge. You can see it has the name. The name even tells you it is an overcharge, which you have to correct it. How do you correct it? You debit property, plant, and equipment, because an overcharge of depreciation basically reduces further an asset. It is not supposed, in this case, to be reduced by 12, but they reduced it by 12. You correct it back. You correct it back. You return it back. It was an overcharge. You know what it means to overcharge? It's like having to go to the shop. You're supposed to pay 10 shillings. Then the shopkeeper tells you pay 15. To correct it, the shopkeeper has to do what? Returns. You have to return the 5 shillings. So we are returning back what was overcharged in the asset account. Then we are returning back to the income. So remember, in this case, depreciation normally does what? Reduces the incomes of the business. So we need to add it back to increase the profits to the correct position. So we are adding it back. We are crediting like that. We are crediting like that. So the unrealized profit, you're having to say 25 over 125. So in this case, it will likely come to how much? What is in this case the unrealized profit on the closing stock? Unrealized profit on the closing stock. Unrealized profit on the closing stock. You get in this case 30. So you'll be able to get 30 million. You'll get 30 million. So this one you'll debit the retained earnings. Remember, it is unrealized. You can see we are treating it in the same way that where you're having to treat it here, unrealized. Unrealized. So we are debiting what? It was not realized. So you have to remove it from the retained earnings. You remove it. When you're removing it from the retained earnings, you need to debit that income account. You debit what? That income account. Then in this case, you credit. You'll end up having to credit the closing inventory. You credit the closing inventory. You credit the closing inventory. So you have to remember now in this case, when you'll be coming up with the statement of financial position, we'll have to remove this amount from the closing inventory under what? Current assets. Under current assets. Under current assets. Then the very last, Excel Limited owed 𝐹 Limited 200 million as at the year end with regard to the transaction in number 5 above. So that is an intercompany balance. The books of Excel Limited, however, showed that it owed 𝐹 Limited 160 million. Excel Limited has sent a check to 𝐹 on 24th of June, but in this case, it was not received until after the end of the year. Remember, we are preparing financial statements as of 30th. As of 30th. 30th of June 2024. But this check was received 2 days later in July. In July. After the year has come to an end. It is money they had sent, but it was still 𝗂𝗶𝗀. It is cash in transit. It has not been received at that other end. So that is what we call what? An intercompany balance that has an element of what we call what? Cash in transit. That has an element of what we call what? Cash in transit. So we can be able to see that is working number 5. That is working number 5. So that we can, in this case, immediately start looking at the computation of goodwill. So that is working. We can start looking at the computation of goodwill. So in this case, we have what? So intercompany balances. Intercompany balances. Intercompany balances on the trade receivables and of course what? Trade payables. So you are told that Excel Limited owed 𝐹 Limited. So Excel X Limited in this case owed 𝐹. They owed 𝐹 Limited an amount of, in this case, how much? 200 million. 200 million. So Excel Limited owed 𝐹 Limited. So it means this Excel was having to report 𝐹 as what? They reported 𝐹 as a trade payable. They reported 𝐹 as a trade payable. While in this case, 𝐹 Limited was having to report, they were reporting, in this case, Z Limited. They reported Z Limited as what? As a trade receivable. They were reporting them as a trade receivable. So Excel Limited owed, when you are owing, you are basically, in this case, a trade payable. You are basically reporting this one as a trade payable, while the one you are owing to is reporting you as a trade receivable, So this amount, of course, was how much? 200 million. It was 200 million. So it was actually 200 million. Then you are told, as at the year end, with regards to a transaction in number 5 above, the books of Excel Limited, however, showed that it owed 𝐹 how much? 160. It owed 𝐹 how much? 160. So in this case, for them, they are reporting this trade receivable at 160 million. This trade payable, sorry. The books of Excel Limited showed that in this case, what they're having to owe 𝐹 is 160 million. The books of what Excel Limited showed that they are owing 𝐹 Limited an amount of what? 160 million. Excel Limited had sent a check to 𝐹 on 24th of June, which was not yet received. It means ideally what is happening, this 𝐹 Limited is still having to report, this X Limited at what? 200 million. So for them, they are basically reporting a trade receivable of how much? 200 million. This is because they haven't received this check. When they receive the check, they will basically do the necessary. And of course, the balance will come back to 160 when they receive it. So it means there's an element of what we call what? Cash in transit of how much? 40. See the difference? 40. So for them, they have already effected in their books because they have already sent the check. So they have effected. So they have reduced the trade payable already by 40. But these ones, they are yet to receive this check. 𝗏𝗔𝗔𝗊𝗀. Imagine 𝗏𝗔𝗔𝗊𝗀. bado ijafika hiyo check. So wao wanafikiria tu bado hiyo deni yao bado ni 200. Iko kwa njia bado inakuja. Itafika huko after how many days? 2 days. On 2nd of what? Of July. 2nd of July. So there's an element of what we call what? Cash in transit. If that is the case, what will happen? Because in this case, with the intercompany balances, we normally end up having to eliminate them. So what will happen here? We'll likely end up having to debit. We'll likely debit the trade payables, debit the trade payables. In this case, with an amount of 160 million. Then, of course, in this case, we'll credit. We'll likely we still debit in this case the cash in transit. We'll debit the cash in transit, which is actually 40 million. Then we'll end up having to credit the trade payables. With, in this case, how much? 200 million. We'll eliminate this one from the trade receivables. So we'll eliminate this 200 from the trade receivables. Then in this case, we eliminate 160, which is here in the trade payables of, in this case, X. Then we consider the cash which is in transit. So there's that cash in transit. We'll end up having to debit it. This one will now affect cash at bank or the cash at hand in the statement of financial position. We'll add it back to the cash at bank or cash in transit in the statement of what? Financial position. So that's what will happen. And of course, that is basically how we'll be able to eliminate those balances. So there's, in this case, 160 which you have to eliminate. Then of course, in this case, there's an element of what we call what? Cash in transit. Then you create what? The trade receivables to remove this balance of 200 million from the trade receivables. And of course, that's basically how in this case you likely end up having to deal with that. How you deal with that? So we can in this case very quickly come up with what? The computation of what? Of the goodwill for 𝑰𝒏𝒕𝒂𝒃 Limited, and of course the computation of goodwill for the other one, which is what? 𝑍𝐵, which is Z. So if you've been able to get that one, you've already been able to copy it. So debit trade payables 160, debit cash in transit 40, credit trade receivables. What ideally it means we'll deduct this 160 from trade payables, we'll deduct this 200 from trade receivables. Then of course we'll be able to add this one in what we call what? The cash at hand or maybe cash at bank. So that's what in this case we'll likely end up having to append. So we can in this case now look at the requirement number 1, which you are supposed to come up with the computation of what? Of goodwill. Computation of what? Of goodwill. Computation of goodwill. So part A, computation of goodwill. So of course you can be able to start with the 𝑰𝒏. We can start with the 𝑰𝒏. And of course for 𝑰𝒏, you've already been able to tell me I'm going to use what? The full method, because you have been given what? The value of, you've actually been given the value of non-controlling, the fair value of non-controlling interest. So how we normally in this case calculate goodwill? So we normally say, so we can put our shillings in millions. Then we can be able to say, so let's do something here. So you can put like this. Then we put like this. So we'll say purchase consideration, which you've actually been given in note number 1. It was 960 million. Remember what I was having to tell you, the cost of investment will be the purchase consideration. Then we normally add on the fair value, If you're using the full method, you add the fair value of the non-controlling interest, which was 240. You're actually given also in note number 1, which was 240. So this one basically comes to 1,200. It comes to 1,200. Then you likely consider now in this case what? The net assets acquired. So less net assets acquired. Less net assets which were actually acquired. So for the net assets acquired, you go to the statement of financial position of 𝑰𝒏𝒕𝒂𝒃. You go there, look at the equity part. You go there, look at the equity part. Suppose the net assets here, we have the ordinary share capital. The ordinary share capital is actually 400. Exactly 400. Then you have the share premium. We have the share premium. Share premium is actually in this case 200. Is 200. Then you don't consider those retained earnings there. You consider what? The pre-acquisition retained earnings. They were how much? Pre-acquisition retained earnings, they were how much? Pre-acquisition retained earnings, they were how much? Pre-acquisition retained earnings, they were how much? 300. 300. They were 300, eh? So 300. Then you consider the revaluation reserves at the date of what? Of acquisition. The revaluation reserves at the date of what? Acquisition. So the revaluation reserves at date of acquisition. Revaluation reserves at the date of acquisition, they were how much? The revaluation reserves at the date of acquisition, they were how much? They were 100. Remember the ones we revalued. Remember what we revalued up there? Remember the ones we revalued, there's an item, or in this case an asset, and of course what? The patents. So it was coming to what? A total of 100. Total of 100. So when you add this one, this is 600 plus 300 plus 1. So it is 1,000. It is 1,000. Comes to 1,000. In this case, it means our value of goodwill in this case, it will be how much? You get the difference. It is 200. The value of goodwill will likely end up having to be 200. It will likely be 200. The value of goodwill will be 200. So that's how you get it. There was no impairment. So if there was no impairment, that is the value of goodwill. There was no impairment, that is the value of goodwill. It will be 200. You get the difference. You get the difference. So it is exactly 200. So that's the value of goodwill in 𝑰𝒏𝒕𝒂𝒃. That is the value of goodwill in 𝑰𝒏𝒕𝒂𝒃. Then we can now in this case compute the value of goodwill in 𝑍𝑑. In 𝑍𝑑, we can compute the value of goodwill in 𝑍𝑑. The value of goodwill in 𝑍𝑑. If there was an impairment, you would have less than 10. But there's no impairment in that question. So let's not bring in a figure we don't have. Let's not bring in a figure we don't have. If there was an impairment, you would have less than 10. But there was no impairment. There is no impairment. You've actually been given there. So it ends there. It ends there. That is the value of goodwill. If there was an impairment, you would have lessened to get the correct value of goodwill. So when we talk about impairment, it's like loss of value of goodwill. So you less, but you haven't been given. So the goodwill is that one. So in this case, we can compute the goodwill in Z. Compute the goodwill in Z. So when you're calculating the goodwill of an associate, when you're calculating the goodwill of an associate, when you're calculating the goodwill of an associate, in this case, we'll use the partial method. We likely, in this case, end up having to use the partial method. We likely use, in this case, what? The partial method. We likely end up having to use the partial method. So what will happen? So what will happen here? So we'll have, in this case, our shillings. Can do shillings in millions. So we have shillings in millions. Shillings in millions. Then we'll do the purchase. We'll have the purchase consideration. Purchase consideration. The purchase consideration you are given in note number 1. It is 240. You are given 240. Then you less the share in net assets. Less share in net assets. You less the share in net assets. So if you look at in this case the statement of financial position, so the net assets of Z, we have ordinary share capital. Ordinary share capital, which is in this case 200. You can see 200. Then in this case, you have the share premium of Z. So share premium. We have share premium of Z, which in this case, it is how much? 100. Which is 100. Then the retained earnings, you don't pick that one. You pick the pre. So you pick the pre-acquisition retained earnings. Pre-acqui retained earnings. You pick the pre-acqui retained earnings. They were how much? The pre-acquisition retained earnings. Pre-acquisition retained earnings. So in this case, it is 200. Exactly 200. It is 200. It is actually not number one. It is not number one. Yes, retained earnings on the date of acquisition, they were 200. There were no reserves, revaluation, there were no assets. Remember, the assets that in this case were revalued were in 𝗔𝒂𝒶, not in Z. So that's why in this case we considered what revaluation reserve in 𝗔𝒂𝒶, not here in Z. There were no assets that were revalued here. So it will end there. It will end there. When you do the total, this one is 300, so it comes to 500. 500. Remember, we are looking at what? The share in net assets. So the share in net assets simply means we'll be able to take 30% because they have a significant influence of 30%. So in this case, we will take 30% of this. So share in net assets. Share in net assets. The share in net assets in this case will likely be 30%. We multiply by 500. So it will come to a figure of 150. Is it 150? Yes, I think it should be 150. Then it means in this case the goodwill here, the goodwill will be a value of 90. There was no impairment that you've been told. So that is the value of goodwill. 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 So it will be 90. So these are basically used what the partial method. So the partial method. That's how you use what the partial method. So in any case, it is, for example, in this case, what maybe in this case it is what? It is a subsidiary, and you haven't also in this case been told you are using the full method. If you're using the partial method, these are basically it flows. These are it actually basically flows. You take the share in the net assets. So when you come here to get the total of the net assets here, you take a portion of it. That basically goes to what? That is actually having to go to the holding company. So then once you get the difference, that will end up having to be the value of goodwill. So if you are told there was an impairment, you'd have gone further to say impairment at 10%. So like that. But you haven't actually been told there's actually an impairment. There's actually an impairment. So that's in this case what the value of goodwill. So we can in this case come up with the statement of financial position. So we go to the statement of financial position. That is part B. Statement of financial position. Statement of financial position. So we got the statement of financial position. So Excel group. So you can do Excel group. Excel group. You can do Excel group. And can we compute full goodwill when you're given NCI in associate? When you're given NCI in associate. So there can be a time in this case, maybe you can actually be told that you won't actually basically be given that fair value of non-controlling interest. So you won't actually be given the fair value of non-controlling interest, but you can actually end up having to compute it. So what will happen? The examiner will actually end up having to give you the market price, will actually give you the market price of the shares, maybe in this case in what? In the subsidiary. So in this case, if you haven't actually been given the fair value, maybe you can be able to write somewhere. Just write somewhere, not in the equation you're having to do, an alternative to computation. Alternative to computation of fair value of non-controlling interest. So sometimes in this case, the examiner can give you a number of elements there that can help you to do this kind of a computation. So the alternative here could be, you can actually take the percentage of, let's say the percentage of non-controlling interest, you multiply, in this case, by the number of ordinary shares, acquired, number of ordinary shares acquired, then you multiply in this case by the market price, you multiply by the market price of the shares, in the And in basically in this case, in what? In the subsidiary. It can be in this case in the subsidiary. In the subsidiary, you'll be given the market price of those shares. Because in this case, when you talk about fair value, is the value at that particular point in time you are talking about the acquisition of the shares. So you can take the percentage of the non-controlling interest, then the number of ordinary shares that have actually been acquired, then you multiply by the market price of the shares in what? In that subsidiary. So the market price of the shares in the subsidiary. That can be an alternative in this case of having to do what? Compute the fair value of NCI. Because fair value is the value at that particular point in time. The prevailing value, considering what? Market conditions. So you're considering what? The market price. This can be an alternative. So sometimes the examiner can hide what? The NCI. And they give you these elements. So the percentage of control maybe in the NCI, then the number of ordinary shares which have actually been acquired. Then they give you, this is the most important thing they'll give you, the market price of the shares in that what? Maybe subsidiary, or maybe that other agent that has actually been acquired. So if you've been given these elements, then you can compute the fair value of NCI. So that is an alternative of having to get that. So that is up, by the way, as regarding that question by Faith. Regarding that question by Faith. But in this case, I want us now, in this case, we start looking at, in this case, the statement of financial position. So Excel group, statement of financial position. Statement of consolidated statements. Consolidated statement of financial position as at 30th of June 2024. I think it is 2024. So in this case, we can start automatically with the non-current assets. We can start with the non-current assets. You can start with the non-current assets. Non-current assets. So you can put our shillings in millions, then shillings in millions. So like that. So shillings in millions, then shillings in millions. Then we start with the property, land, and equipment. So remember, we'll actually only be considering the assets of the holding company and those ones of the subsidiary. So if you look at property, plant, and equipment, we have 2,100. We have 2,100 and 1,500. Don't add 900 because we said for the associate, we don't consolidate it, but of course, we calculate a very special element. We call what? Investment in associate. We calculate a very special element. We call it what? Investment in associate. So we don't basically be considering those assets of the holding company and those ones of the subsidiary. So there, in this case, for property, plant, and equipment, you can be able to see we have 2,100 plus, in this case, how much? 1,500. But remember, there was a revaluation. There was a revaluation of how much? There was a revaluation of how much? There was a revaluation of how much? 80. So we have to add it. There was a revaluation of 80. Remember that asset that was revalued. Is it not number 2? There was a revaluation of, in this case, 80. There was a revaluation of 80. There was, in this case, also what? Depreciation overcharge of how much? Depreciation overcharge of how much? Is it 8 or 12? Omondi confirm. There is overcharge and undercharge. There is overcharge and undercharge. There was a depreciation overcharge. When they were having to sell the fixed asset, they overcharged. Remember that computation that we did? And of course, someone was asking, where is the 20% coming from? Where is the 20%? There was that overcharge. So it was reducing the asset, but you have to correct it back. Remember, we corrected it back. So you say in this case, you'll end up having to add back. Well, you add back 12. And realized profits. On the fixed asset, it was how much? 60. Senior. It was 60 Mudhoni. Was it 60? Unrealized profit on the sale of the fixed assets, was it 60? Mudhoni. Confirm. Remember, this is the entries I told you make there. Those are the standard entries. So when you do that computation, you basically debit. You debit, in this case, what? The retained earnings. Then you credit what? The specific asset account. So minus 60. Then there was an overcharge on this, which was of how much? There was an overcharge on that of how much? 8. Senior. There's an overcharge of 8. Remember the overcharge you calculated, and debit, you credit. It was 8, so we less 8. So what do you get as the value of PPE? What do you get as the value of property, plant, and equipment? But there's something about this one. There was something about this one. There's something about this one. So if you look at the computation we did, so this 8, there was a depreciation in this case, what? Undercharge. So in this case, it was a depreciation undercharge, not overcharge, but undercharge of 8. Depreciation undercharge of, in this case, what? 8. So you are told that if you just look at the same note, so that in this case I can bring the point home, I can be able to bring the point home. There's something about that one. So immediately prior to the date of acquisition, 𝗔𝗶𝒄 Limited revalued its non-current assets in readiness for the acquisition as shown below. That is not number 3. So they revalued equipment with a value of 80. So of course you are told the remaining useful life after they revalued it was how much? It was how many years? 10 years. So it means depreciation per year, it is how much? 8. But remember the date of acquisition of 𝗔𝗶 was when? Kuna pale umeandika in the group structure, kuna mahali umeandika 2 years. In the group structure, kuna mahali umeandika 2 years. So take 2 times 8. Does it make sense to you? Take 2 times 8, Valerie. Does it make sense to you, Valerie? Yes, it is making sense. So in this case, you'll end up having to less 16 because they in this case undercharged for 2 years. Up to the point in time, we are preparing the financial statements. So it will be 16. It will likely in this case be what? Be 16. So what do you get in this case as the value of PPE? What do you get as the value of PPE? 36, 16. So you get in this case 36, 16. You get in this case 36, 16. Then we can go to the next one, which is the intangible assets. We can go to the next one, which is actually intangible assets. In this case, we have 400 plus 300. But remember, they were revalued by how much? They were revalued by how much? They were revalued by how much? 20. So we'll have to revalue them up. Then there was in this case what? An undercharge on what? Amortization. What will be the value of that undercharge? Valerie. What will be the value of that undercharge? What will be the value of that undercharge? Someone says 8, 2. You're not seeing something about that too. There must be something you have to say about that too. It is 4. It is 4. Does it make sense? Remember, 2 years. Does it make sense, Modoni? 2 years. So it will be 4. It will be 4. So there was an undercharge in amortization of 2 per year. But remember, since the date of acquisition, they have been doing it, that undercharge has recurred for 2 years. So it is 4. Nekesa, does it make sense? It should be able to make sense. So what is in this case the value of intangible assets? What is the value of intangible assets? The value of intangible assets, just do 400 times plus. It is 7 what? 716. Is it 716? It is 716. 716, sindio? 716. So it is actually 716. It is 716. It is 716. Yes, 716. Then in this case, we can be able to go to you have in this case goodwill. You have in this case goodwill. Goodwill, it will be how much? In this case, remember, we've actually been able to compute here. It is actually coming to 200. It is coming to 200. We only consider that one of the subsidiary. Then there is of course the investment, but investment in 𝗏𝒂𝒃 itabaki 0. There's of course investment, but itabaki 0. So of course we can just be able to put it investment, which is in this case 1400, but you have to less what? the purchase considerations, which in this case it was 960, then 240, then 200. It comes to 0. In any case, there was any amount remaining, would have placed the figure here. But it comes to 0. So it comes to 0. So we leave it like that. So investment in associates. Investment in associates. Remember, this is the special figure we said you'll be able to consider for what? For the associates. You can leave it. So it has complicated calculations. So we can go to the current assets. Current assets. You can go to the current assets. You can go to the current assets. So for the current assets, we have what? Inventory. Inventory. We have inventory, which in this case will be 700 plus 600. Then we less what? Alex, we less what? Then we less what? So this one you've left it faster. So just leave it fast. So it is 700 plus 600. We less what? We less 30. So that's the unrealized profit on what? On closing stock. So we less 30. So we less 30. So it is 1300, 1270. If it comes to 1270, we can place it in this column. 1270. It comes to 1270. Then we can be able to go to, in this case, trade receivables. Trade receivables. Trade receivables. Trade receivables. In this case, we have 640 plus 340 minus 200. Remember that 200. This one comes to 980 minus 200, 780. So this one is 780. Remember this 200, the intercompany balance. Remember, is the last working you've done. So you say credit what? Trade receivables 200 to eliminate that intercompany balance. Then you have financial assets. Financial assets at fair value. So these ones don't have any form of adjustment. So 360 plus 260. So you get 620. In this case, 620. 620. You get 620. 620. 620. 620. So I want to wrap so that you can be able to continue. So because down there you won't be able to see, and I don't want to start adjusting that camera. It will cause chaos. It will cause chaos. It will cause a lot of chaos. So we can continue. We can continue in this case. We have now what? Bank and cash. Bank and cash. Bank and cash. So for the holding company, we have 200. 200 plus 100. 200 plus 100. Then we do what? We do what on it? Valerie, what do we do? Valerie, what do we do? Valerie, what do we do? We add what? 40. That's what we call what? Cashing. We deducting Omondi. Remember we said what? Debit, cashing, transit. When you're debiting cash, you are basically increasing it. So in this case, we add. Don't deduct Omondi. We add. We add because you are debiting cash. So it comes to 340. 340. 340. So get the total. What is the total value of, in this case, what? Current assets. The total value of current assets. Add them. Simuli is here. Simuli is here. What do you get? Simuli, what do you get in this case as the value of current assets? Add them. 1270, 780, 620, 340. 1270, 780, 620, 340. 30, 10. You get 30, 10. So 30, 10. So just place the figure there. Don't put the totals because kuna kizungumkuti hapo ya investment in associate baada tujafanya. So we can go to the other side, equity and liabilities. You can go to the other side, equity and liabilities. Equity and liabilities. We go to the other side, equity and liabilities. So we start in this case with the ordinary share capital. Hii haikuangi na story mingi. Hii inakuwa tu mambo mdogo. You take those ones forward for the holding company. You take those ones forward for the holding company. So in this case, we have what? We have in this case, for the holding company, you take those ones for the holding company. So we have We have in this case ordinary share capital of yeah, it is 1,600. Then share premium of how much? 1,400. So you have in this case 1,600, and of course in this case what? 400. So 1,600 and of course what? 400. So you have ordinary share capital and share premium. So you have in this case 1,600. Of course 400. You take those ones for the holding company. So they rarely in this case have adjustments, those ones. So then in this case, you can have retained earnings. Retained earnings, it has adjustments, so you can leave it for now. Just leave it for now. Leave it for now. Then in this case, we have non-controlling interest. Hii unajua tu mambo yake. Unajua tu mambo yake. Leave it for now. So unaelewa tu mambo ya non-controlling interest. Then we go to non-current liabilities. You can go to non-current liabilities. LCIs unajua tu mambo yake. Wachana nao kwanza. Isikukule kichwa sahi. Non-current liabilities. Non-current liabilities. Non-current liabilities. So for the non-current liabilities, in this case, we have 10% debentures. 10% debentures. 10% debentures. Then it will be 1,200 plus those ones of the subsidiary 400. Then we do about, what do you do about it? What do we do about it? What do we do about it? 1,200 plus 400, then we do what? Well, then we do what? Well, similarly, then we do what? 1,200 plus 400, then we? Nekesa, what do we do? Remember what I said there under note number 1. Nakumbuka nikisema when we go to the, we'll eliminate it. Remember what we said. So less 200. We'll eliminate them, so 200, because they were acquired by what? A member of the group. It's like an intercompany balance that you have to eliminate. They were acquired by a member of the group, so which is the holding company. So you eliminate it, 200, so you get 1,600 minus 200, you get 1,400. It is 1,400. Is it 1,400? Yes. So we can just maybe put it here. Just put it there, 1,400, 1,400. Then the next item is deferred tax. Deferred tax, in most of the instances, hainanga adjustments here. Hainanga adjustments here. Deferred tax, in most of the instances, in group, hainanga adjustments. Na current tax, hazinanga adjustments hizo. Hazinanga kabisa. Hazinanga. So deferred tax. So the next one is deferred tax. So you add those ones of the holding company and the subsidiary. So you have in this case 500 plus 200. So you get 700. You get 700. Then you can go to current liabilities. So current liabilities, we have trade payables. Trade payables. We have trade payables. So you have 600 plus 700. Then we do what about it? 600 plus 700. Then we do what about it? Nekesa. We do what about it? We do what about it? We minus 160. So unakumbuka ile 160. So unaikumbuka tu ile 160 yetu ile inasema debit cash in transit, debit trade payables 160. Credit trade receivables. So unaielewa tu. So you get 1140. 1,300 minus 160, 1140. 1140. Then we have current tax. Current tax. You take for the holding company and the subsidiary. So it is 500 plus 300. So in this case, we have 800. We go to, in this case, what? Proposed dividends. We have in this case proposed dividends. Proposed dividends. Proposed dividends. So in this case, for proposed dividends, so we'll have it is 200 plus 200. It is there. It is 200 plus 200. See you. 200 plus 200. But these dividends will do something about it. Who can be able to tell us? These dividends will do something about it. But these dividends will have to do something about it. who can be able to tell us what you need to do about these proposed dividends? The one from the subsidiary. These dividends, you'll have to do something about it. Hata wewe jaribu kufikiria kidogo, wewe. I can see Valerie has tried. Less from retained earnings. Less from retained earnings. Less from retained earnings. Less from retained earnings. Less the one paid from the subsidiary, which was how much, Lavin? Less the one paid from the subsidiary, which was how much? It was 160. Someone says 150. Next umepata 160. Next umepata 160. Tuambie vile umepata 160. Next umepata 160. David wewe umepata 150. Umesema the correct statement, but that 150 figure is not correct. You less 80% of what? Of 200. Because in this case, what is happening, you know, when these guys propose these dividends, 80% of it actually ideally is having to go to the holding company. And that is like, in this case, what? An intercompany balance. You eliminate it. It's like an intercompany balance. Just the same case, like in this case, tunaambiwa hapo walinunua nini, au walinunua the 10% debentures. So these ones are paying dividends. 80% of these dividends they are proposed to pay. Actually, it will go to the holding company. Watachukua hizi pesa wawalipe. You eliminate those balances, so you eliminate it. So you actually basically take 80% by 200. You less that, so you less 160. So it will basically remain what? 240. 240. But of course, also hii inaenda kupatikana kwa retained earnings. So hiyo point hapo tumeambiwa na nani, retained earnings pia kuna vile inaingilia, but you're going to see basically when you're coming up with the figure for the retained earnings. So ideally they end there. So you eliminate. In any case, you are told there was dividends paid from the subsidiary to the holding company. You have to eliminate, remove them. You have to remove them. You have to remove them. So also that dividends that was paid by the associate, tutaiconsider pia. So let's now come up now what investment in associate. We'll consider it. So we'll eliminate this, away we remove it. So that's basically in this case the end of what? Oh, the current liabilities. The current liabilities. So that is the entries. Those are the entries. So we go to the elephant. We go to the elephants in the room. What are the elephants in the room? Investment in associates, NCI, and retained earnings. So have you been able to write up to there? Because we want now in this case to go to the elephants in the room. We want to go to the elephants in the room. The elephants in the room is what? NCI, retained earnings, investment in associate. So if you are through, maybe in this case I need to be able to wrap very fast. We go to the elephants in the room. The elephants in the room. The elephants in the room. So let's in this case maybe start with the retained earnings. So I don't know if it will be a working number what. Maybe it could be a working number 6. But I don't know if it will be what. So in this case we can do the retained earnings. Retained earnings. You can do the retained earnings so that you plug in the figures there. You plug in the figures there. So you will start with in this case the retained earnings of what? Of the holding company. So in this case you have what? The retained earnings. So the balance brought down, in terms of what in this case, the holding company. In terms of the holding company, this one you'll be able to get it from the statement of financial position because you are told they are under the equity and liabilities, equity and reserves. We have in this case retained earnings of 𝗥𝗏𝗀 Limited. That is, this is 𝗥𝗏𝗀 Limited. We'll just be able to say retained earnings for 𝗥𝗏𝗀 Limited. 𝗥𝗏𝗀 Limited. So it is actually how much? 800. It is 800. It is of course, we have in this case shillings in millions. Shillings in milli. So this one is 800 million. 800 million. Then on these retained earnings, we'll be able to do a number of adjustments. A number of adjustments of the happenings that actually basically affected, especially majorly what? The post-acquisition. The post-acquisition what? Retained earnings, retained earnings. So in this case, on these retained earnings that they had already reported, of course, they realized somewhat dividends. So we'll add, they realize some dividends from the subsidiary and of course what they associate. So add dividend receivable, dividends receivable. So when they receive these dividends, it will basically be part of what? The retained earnings. It will be part of the retained earnings. So dividends receivable. So you have in this case Y limited. So for Y limited, it is 80%. 80%. We multiply in this case by 200, which was the proposed dividends. These proposed dividends, you can be able to see it in the statement of financial position. You can be able to see it there. So it is actually 160 when you do the computation here. Then in this case, we have from Z limited. So for Z limited, they had a significant influence of 30%. So from there, it is 30%. And of course, from the statement of financial position, in this case, you have a proposed dividends from, in this case, what? The Z limited of 100. So this is part of what will be able to increase their what? Retained earnings as the holding company. So it will increase. So this one comes to what? 30. It comes to 30. So it will be able to increase. Apart from the dividends they'll be able to receive from the subsidiaries, you also have in this case what? Share of the post-acquisition profits and share of post-acquisition profits. Share of the post-acquisition profits. And of course, these post-acquisition profits, still we have them in Y limited and of course Z limited. So of course, in this case, their share in Y limited is of course 80%. Then it will be what minus what? Who can be able to tell us? It will be what minus what for Y limited? The post. Remember what you mean by post. Post, not pre, post. It is post after they are acquired. How much did they share in the profits to increase their retained earnings so that we can get together all of them? Who can be able to tell us? We'll take what minus what? Pia wewe fikiria kidogo wewe. Nekesa jaribu kufikiria kidogo. Try to think. Faith says 700 minus 300. Someone else can also be able to tell us. Able to try. Can be able to try. Sometimes the power of guesswork. So I just end up having to work magic in the exam. So it is 700 minus 300. Then remember we're talking about the post-acquisition, after they are acquired. The post-acquisition. So in this case, it is what? Let me say 700 minus 300. Je, umejua vile tumepata hiyo 700 minus 300 ama ujui? Kama ujui penye imetoka useme. So if you look at note number 1, when they were acquiring, you can see this figure. This figure, you're able to see it. 300, you can see it. Note number 1, when they are acquiring this Y limited, you are told there was a figure of retained earnings at that particular point in time. It was how much? 300. You can be able to see it. Then, if you look at now in this case, what? The statement of financial position at 31st. If you look at the statement of financial position at this particular point in time, you are combining. Look at, in this case, the statement of financial position of what? As of 30th of June, of in this case, what? YEP limited. You are told you have retained earnings of how much? 700. And you know what happens with retained earnings? What unazi accumulate to? Kama hii 700, sasa tutaibeba tuipeleke next year, tuongeze zile za retained earnings za next year tukiendelea na maisha. So kama next year tuta realize a profit of 100, tutaongeza hapa. So retained earnings za next year zitakuwa 800. The other years ilikuwa 200, tunaongeza, inafika 1 million. So they have been doing that, they have been accumulating in this 300 since they acquired. Paka imefika ngapi? 700. So the post is the difference between the two. So 80% of that, it comes to 320. So it is 80% of 400, which is what? 320. So Omondi, are we together? So the post, you take the share of the post acquisition what? Profits. And of course in Z tunajua na control 30%. And of course now in this case for Z, say naongelelea 30th of June, they have what? 500. When they were acquiring, they had how much? 200. See, they had 200. So what is that? This is 300 by 30. Is it 90? I think it is coming to 90. It's coming to 90. It's coming to 90. It's actually coming to 90. It is coming to 90. It is coming to 90. Yes, it is coming to 90. So you'll be able to add that one. Then also in this case, we'll have in this case what? there was in this case what? An overcharge of what? Of depreciation. An overcharge of depreciation, which in this case we got what? 12. In this case, got 12. Depreciation overcharge. So we add. Remember to go to the debit. Remember to say for debit retained. Is it credit or a debit? So depreciation overcharge. We ended up having to do what? Credit. We actually said in this case credit. If you look at that entry of 12, if you look at the same working, I think I was able to indicate we debit property, plant, and equipment by 12. We credit retained earnings. We credit what? Retained earnings. Y was acquired 2 years ago. So, in this case, what they mean by post acquisition profits. Just from the term itself, don't think so deeply. Post, after you acquired, what were your retained earnings you accumulated after that? If you start thinking so deeply, you'll get confused. Post, after acquisition. The acquisition date, of course, it is 2 years ago. When you are acquiring it, at that point in time, you already told it not number one. walikuwa wananunua retained earnings za hii ilikuwa 300. Wamekuwa wakizi-accumulate is the last 2 years. By the end of after 2 years, imekuja 700. So after this debt, what is the post? What have they been accumulating until they got here? That is the post. Catherine, are we together? That is the post. So the pre is this one. So before they acquired it, at that particular point in time, kurudi nyuma, walikuwa wameaccumulate hiyo subsidiary ilikuwa imeaccumulate up to 300. Up to 300. So that's what they mean by that. It's clear. So I think it is clear. So there is in this case what? That overcharge. Remember what we said there, credit what? Retained earnings. So in this case, we'll end up having to, in this case, add depreciation overcharge. Depreciation overcharge. We'll take 80% of it. So 80% multiplied by 12, you get 9.6. 9.6. So you need to add those items. This is like having to credit. If you prepare a T account, these items, you are crediting them. So you are crediting them. If you prepare a T account, you are crediting them. So we now, in this case, look at what you'll end up having to less. We need to less. We'll actually, in this case, end up having to less other items here, which of course, you remember, sometimes we're having to say debit the retained earnings. So you have, in this case, depreciation undercharge. Depreciation undercharge. Depreciation undercharge. We have depreciation. I don't know whether you'll be able to see here. I don't know whether you'll be able to see there. I think we won't be able to see there. And please move it here. So you can list those are the other items. Less depreciation, undercharge. Undercharge, it will likely be 80%. Multiply for the last 2 years, it has been 16. It will come to 12.8. Then amortization undercharge. Amortization undercharge. They have been undercharging amortization for the last 2 years. So it means we have to correct on the profits that they were reporting. So in this case, it will be 80% multiplied by 4. It will come to 3.2. 3.2, it will come to 3.2. 3.2, 3.2. You guys, I don't know whether you're able to see there. You are not able to see there. You are not able to see there. So it is 80% by 16. You'll be able to get 12.8. Then is that undercharge? I think you are not able to see there. So what we do, you can be able to move it here. You just move it here, so there's no problem because you've already written. Just move it here. But remember, you make sure you are continuing. Don't write it separate. You're just continuing. So less depreciation, undercharge. It is 80% multiplied by 16. So you'll be able to get 12.8. Then in this case, we less amortization undercharge. Undercharge. In this case, it is 80% by 4. Multiplied by 4. We'll be able to get 3.2. 3.2. 3.2. So these ones you are lessing. So these ones you are lessing, you are having to less. Then we have in this case unrealized profit on sale of fixed assets. Unrealized profits on sale of fixed assets, which was 60. In this case, don't take the percentage. So it was actually unrealized in this case in what? In those subsidiaries, in the holding company. It was unrealized in the holding company. Then unrealized profit on closing inventory. Unrealized profits on closing inventory. So you take 80%. 80% multiplied by 30. By 30. So you'll get in this case 24. So you need to do the computation and give me the figure for the retained earnings. So what you get as the retained, you need to add from up there, then you less these ones. You need to add from up there, then you less those ones. What you get as the figure for the retained earnings, the figure for the retained earnings. What you get as the figure for the retained earnings? You need to add them, then you less these ones. This was depreciation undercharge, amortization undercharge, unrealized profits on fixed assets. Then you have unrealized profits on closing inventory, CI. So 80% of 30. So you come to 24. So you need to add the ones we had done previously, then you less these ones, you get the figure for. You get 1309.6. So 1309.6. So that's the figure for the retained earnings. We can now in this case do the computation for NCI. Let's do NCI. Let's do NCI. So let's do the NCI. So if you've been able to write, because I want to wrap so that we can do NCI. So working 7, so the non-controlling interest. So non-controlling interest. The NCI. So you start with the fair value of NCI. So I have shillings and millions. So the fair value of NCI, you've actually been given fair value of NCI is an amount of 240. 240. Then you add share of post-acquisition profits. Share of post-acquisition profits. Share of post-acquisition profits. So in this case, we are considering non-controlling interest basically in what? In the subsidiary. So you'll take 20% of the 700 minus 300. Remember, it is what you are not controlling. It is what you're not controlling. The other percentage, which is 20. It is what you're not controlling. You are basically getting what is the value of the minority shareholders in the entire group. What is the value of the minority shareholders in the entire group? So the fair value of NCI, you add the share of the post-acquisition profits which went to them, not the holding company, went to them. So you take 20% of that. So you'll likely be able to get, is it 80? Likely be able to get 80. Then you add depreciation overcharge. Depreciation overcharge. So there's a share of 20%. 20% multiplied by 12, you'll be able to get 2.4. 2.4, you get 2.4. Then less depreciation undercharge. Depreciation undercharge, it is actually 20%. Multiplied by 16, you'll be able to get 3.2. Then you less amortization undercharge. amortization under charge. It will be 20% multiplied by 4. 20% multiplied by 4, you get in this case 0.8. 0.8. Then the last item, unrealized profit on closing inventory. On closing inventory, which went to the NCI, it is 20% by 30. So you'll be able to get 6. So those are the items. You add the share of the post-acquisition profits that went to the NCI, the depreciation under charge, which in this case ended up having to affect the NCI. Then the depreciation depreciation over, this is the overcharge. This is overcharge. This is undercharge. So for the undercharge, in this case, you lessen. It will reduce the values of, in this case, what? It will reduce the values of the NCI. So then you do the addition. You go to do the addition. Do the addition. So 240 plus 80 plus 2.4, then minus 3.2, minus 0.8, minus 6. What do you get? So 240 plus 80 plus 2.4 minus 3.2 minus 0.8 minus 6. You get 312. Is it 312? So confirm. 240 plus 80. That's already, in this case, 320. That is already 320, see? Plus 2.4. $320 plus 2.4. You get what? 312.4. Okay, so 312.4. 312.4. Hope it is correct. 312.4. Then in this case, you can quickly look at the investment in associate. Investment in associates. Investment in associates. The investment in associates. The investment in associates. The value of investment in associates. So you'll start with the cost of investment. The cost of investment. When they invested in the associates, the cost of investment, they had actually invested how much? 240 million. So they had invested 240 million. So then in this case, what was the goodwill? The goodwill in the associates. What was the value of the goodwill in the associates? And goodwill in associates, which in this case we computed and got it was actually in this case 90. It was actually 90. It was actually 90. Then there was a dividend income, receivable. So dividend income. Dividend income receivable from the associates. Dividend income receivable from the associates. So of course it was 100, but now, so we are only having to take what, 30% of that. So multiplied by 100. So we got a goodwill in the associates. And further to this, we actually also got what, a portion of the proposed dividends, which was coming to 30. In this case, it is 240 plus 90 plus 30. I think it will be 360. It will be 360. So you can pick those figures and of course place them in the gaps you had left. Pick those figures, pick the figure for investment in associates, non-controlling interest, and the one in this case for retained earnings. Then in this case, you place them in the statement of financial position. So then you can be able to ascertain whether in this case it can be able to balance, whether in this case they'll likely be able to balance. So this was the non-controlling interests. And controlling interest, it was 312.4. So you can be able to put those figures there, Then just be able to ascertain whether in this case it is having to balance. Just be able to ascertain whether in this case it is having to balance. If it is balancing, you can be able to say it is balancing, it is okay. If it is balancing, you can be able to say it is balancing, it is okay. Beatrice, is it okay? Is the balance sheet okay? Just place those figures you've been able to come up with here. 7902 on both sides. So I think it is okay. So there was someone who was actually requesting we look at cash flow. So there's a minimal chance it will be tested, but of course, we'll see whether we'll be able to look at it. Let's see whether we'll be able to look at it. Then just the same setting. Just the same setting. There's question number 5. The entire question number 5. So look at that question. Question number 5. Then question number 3B. So those are the questions in this case we'll be able to tackle in our next class. So we have question number 5, just the same setting. Question number 5, and of course in this case question number 3B. So look at those questions. Question number 3B and question number 5, just the same setting. August 2024, question number 5 and question number 3B. So those are the questions we'll be able to look at in our next class. Then maybe in the very, very final class, maybe we'll be able to look at cash flow. We'll be able to look at cash flow. So any question you might be having, you can be able to ask, but ideally, I would like to close there. I would like to close there for today.